Unfortunately, our colleague Harry is ill, and so as the Vice Chair of Investment Committee, I have the distinct pleasure of serving as the Chair of the Investment Committee today. So, item number 1 is approval of the committee agenda in open session. Sorry, roll call. I always forget the roll call, so you always have to remind me. Go ahead, roll call. Come on.
Okay. For the State Treasurer, Ms. Miller. Mr. Lawson. Ms. Dillon.
Here.
Mr. Rosensteel.
Here.
For the State Superintendent of Public Instruction, Ms. Zumot.
Here.
And for the State Controller, Mr. McGuire.
Here.
Ms. Hendricks, you have a quorum.
Excellent. All right, thank you. So item 1 is approval of the committee agenda.
So moved.
Second.
So all those in favor, aye.
Aye.
Opposed?
Nay. Oh, never mind. I was just going
She's
right along with
co-chairing
what
with
you're
me
saying.
today. No worries, great. All right, that's approved, thanks. So we're going to head into closed session now. Get started. We've got Chris, item 9, our CIO report. Mr. Ailman.
Thank you. You saw yesterday the 100-year logo, so we'll start trying to use that in our presentations more often. To run through this fairly quickly, I'm glad Client Advisory Committee has gotten out, so the teachers and the members in the back can get the information. At March, March 28, March 31, the portfolio closed at $163 billion. I am pleased to say, while it's an interim, unreconciled number, as of Wednesday's close, when the market had hit a new high, we closed at $165 billion. So first time we've been back to 165, obviously since 2007, but it is nice to be back there. You can see the steady growth we've had so far this year, fiscal year, which has been very strong. Our return so far this fiscal year, knock on wood, is double digit. I don't want to report it. P&I is here, and I'm sure Bloomberg's watching. But so far, we're doing very well in this fiscal year, thankfully. There's the asset allocation. Everything is within the asset allocation ranges. We are fairly low in fixed income, and that has been a dedicated strategy on our part. This year, it has paid off. You can see private equity and real estate, they're within the ranges. Inflation sensitive and overlay are still very, very small. Cash position has been moving around. We're in a time period where we generally have a pretty negative cash flow. Our cash flow gets very negative in the summertime when contributions stop, as you can imagine. Here are the returns fiscal year to date, and that really shows you how powerful the year is. The U.S. is up 14%, but what really is amazing is the rest of the world. UK, Germany up even stronger, even though we talked so much about the European distress. The big number is, as I highlighted yesterday to you in my email, is Japan, up almost 40% fiscal year to date. That has all to do with the Bank of Japan basically following Bernanke and saying, we're going to print money. And we're going to try and stimulate the Japanese economy. They've tried it before, but not to this scale. Also notice Australia. Still demands for natural resources, and Australia is benefiting from all of that Asian. The fixed income returns you can see over on the side for the first time in a couple of years are low as we would normally expect them to be, and they are back down where rates have not dropped, so they're going to be very low, mostly coupon income. But a very nice equity return. So this chart's very busy, but in a nutshell, this is the first quarter of 2013. I think what's most fascinating about it is it was a quarter where, remember, in December 28th, all we talked about was going over the fiscal cliff. The world's going to end, sequester. Will the government even be operating? And look at these returns. Just remarkable. The highest returning things were equities and high yield. That's the far end of the scale. And this quarter actually ranks in the top quintile, so the top 20% of quarters dating back for 80 years. One of the better equity market quarters, which is just amazing considering all the literature you would have read right up to the day this quarter started. We went over the fiscal cliff. Obviously, you know the partial solutions and the sequester, but risk assets did well. And the underperforming assets tended to be metals and commodities. There's some other things that are mixed in there, but you can see some of the base materials, gold, wheat being the worst performing asset, copper, I've told you before, we call copper Dr. Copper because it really is a good gauge of the health of the global economy. So that's a pause to worry about coming into the second quarter and later on. So the fiscal cliff, I guess I already kind of preempted myself, but here's where the return of the market has been fiscal year to date. And then here, if you zoom in on just the first quarter of this year, you can see it really was remarkable in terms of the gain. So while Alan will go through how we've done up to December 31, this is one of the few times we would highlight and say the world changed even more in the first quarter. And so while the numbers are mixed, and some of the things we talked about even in closed session where things have done poorly, this quarter was so healthy, those things turned around and now are doing well. So it really is very time period specific when we look at performance. There's our asset allocation. I had highlighted we're within the ranges. You can easily see that fixed income is near the bottom. And then lastly, looking out to the second quarter. So what's out on the horizon? We do this every investment committee meeting for those that are new. People are worried about the earnings per share in the S&P 500. Alcoa reported, so we're right at the beginning of the quarterly reports from corporations, and the general news has been slightly lower, negative forecasts from CEOs. So that's a concern. We've really been doing well on earnings per share growth out of the S&P. Obviously, the sequester impact is huge. Then Iran, Sudan, Syria, North Korea. If you recall, I told you that I think Iran really may become an issue in April and May. That still is kind of the time period people in the Middle East are worried about, but obviously right now all attention is in North Korea. And that is certainly a wild card. So the other one to keep an eye on, you're going to hear a lot coming up about Italy. Italy still does not have a government. Normally that would kind of be a problem, but Italy seems to be doing just fine without a government. So kind of interesting. Maybe they're our new test case, kind of an interesting concept. But the European debt concerns are not going to go away. It still is, as I've been telling you, a beautiful deleveraging, but those are going to pop up on a reoccurring basis. And then obviously the internet disruption hacking for some of the new members, honest sake, we have been listing that as a concern for about 3 years. We've subscribed to a global risk service, and that has been the #1 risk for them for over 3 years. And so it will stay up there for a prolonged period of time. And then obviously any kind of natural events, and this time I started adding near-Earth objects because now we're much more aware of that as a potential catastrophic into the Earth. So on the positive side, let's look on the other side of the ledger. As we've been saying, slow, steady growth. The housing market is improving slowly, not dramatically, but it is coming back. We agree with Bridgewater's assessment. This is what we would describe as a beautiful deleveraging. Deleveraging should, by their nature, be very painful. That means it's a balance sheet problem, not an income statement problem, and so it takes time to work out, but it's been working out. And I think the big key for me is you don't fight the Fed. It's an old Wall Street analogy of don't fight the Fed. Big Ben Bernanke is stimulating money. And so you don't fight the tape and you don't fight the Fed. As long as he's encouraging everyone to buy risk assets, that seems to be the right investment. Given that wall of worry on the other side, it's tough to just blindly follow that. But I think that, in a nutshell, I've often been asked by people, why is the equity market at all-time highs when GDP growth, employment are so slow? That is the whole reason. And the thing I would point out is the Feds all around the world. We've talked about the ECB, Draghi and the ECB, who I think was a classmate of Bernanke's, but they're working out of the same book, and now we have the Bank of Japan working out of the same book. As you read later in that book, we know that asset buying binge usually does not end well. David Stockman's published a book, and he's been out on the radio and TV and, boy, everywhere, publishing the point that that's going to end badly. The challenge is when. Can you pull off a beautiful deleveraging and not have it end badly? We're going to live through it, but right now, that is not on the near-term horizon as much as he would like to make it, because people will buy his book if he gets you worked up. But those are just basic economic theories that we don't know the answer to, but we're going to keep watching it. And that leads you to the last one, which we will talk about in the capital market assumptions, is the historic low interest rates, 200-year lows in the U.S., 300-year lows internationally in the U.K. in interest rates, and low for the foreseeable future. You're going to see a lot from me in the weekly econ update about whether the Federal Reserve, they're talking hawkish, which means they're talking about raising rates, or think of it this way. We used analogies yesterday. They're talking about taking their foot off the gas pedal. That is a big move. That would be a huge sign for the equity markets and the bond markets. They're going to talk about that, but the reality is they have their foot on the gas pedal and it's on the floor. They're flooring it and pushing it. What we worry about is, will they ease off that gas pedal, and boy, will they ever touch the brake. The brake would be raising short-term interest rates. And if you remember back in the old days, we all used to hang on the word of Alan Greenspan, you know, that the federal funds target was cut 0.25% or raised 0.25%. The equity markets would go wild. Obviously, you don't hear that anymore because the rates can't go lower. So right now, we're still in QE infinity, and the challenge is, will we stay there? Last off, a couple of positives I want to raise and hopefully start the meeting off with some good news. I really wanted to highlight our infrastructure team. It's tiny. It's only D'Lo, Chris, and our student intern, who's a PhD student from UC Davis. So we're working on getting a rocket scientist. But really, D'Lo and Chris, and they were recognized by Infrastructure Investor Magazine, which is an international magazine. We won or were named #2 in terms of the Global Investor of the Year. We normally don't ever celebrate being #2, but I wanted to point out Canada Public Pension Plan, which is bigger than us, has been at this for over a decade. And obviously, you know, Ontario Municipal OMERS, which has got Borealis, which is a private money manager. So for our little 3-person team to actually rank up that high and get national recognition, our infrastructure group's on the map. So. And then lastly, I just wanted to share with you, I guess, I don't know if I'd call it a civil war, but it's a morale issue in the investment office, and it's divided the office. Not very fairly. So at the start of baseball season, realize that most of you are probably from Southern California. We took that picture, you can see 30 Giant fans to 5. We had Jersey Day, and we definitely have a core of little Dodger fans. It's kind of interesting. I'm sure they're cheering up there, but right now it's little. Well, we're in Northern California, but yeah, it is rather fun, and we do celebrate that rivalry. Questions? Pardon me? You know, I have not bothered to look at a sports page in a heck of a long time. I don't know who's ahead, I have to admit. You bet.
Item 10, approval of the minutes for the February 7th. So item 10, approval of the minutes for February 7th investment committee meeting. Open
So
session.
moved.
Second.
All in favor, aye?
Aye.
Opposed? Any abstentions? Okay. Did you get that, Lima? Anna, abstain.
Standing on the minutes.
Okay. Great. Item 11, Margot. Private equity.
Oops. Hit the wrong thing.
Is that you, Margaret? Am I on the
That's
wrong?
on your consent calendar, so unless you want to pull that
okay.
item,
Okay. So what
you
do
can move approval of the consent.
Okay, great. Move
Agenda.
approval. To have a movement to approve.
So moved.
Second?
All in favor, aye?
Aye.
Opposed? Abstentions? Great. All right, thanks. All right, so now we have Chris, you again?
Back to me. So settle back in your chair. We have, this is really the guts of our asset allocation study, and this is huge. So I would invite John Robinson and staff from Gray and Company, and then Alan and Neil, if you want to come forward and get situated. We divided this item into 2 steps. We need you to take action on both of them. The first one is the capital market assumptions. These are absolutely critical inputs to your asset allocation study. So when you think about the big picture we talked about yesterday with the actuaries, what is our risk? What's our return? This is the core input to it. Then we're going to get into the key decision factors. So sort of what are your priorities? How do you want to vote on those? So let me go through this really quick. I said in my paper, and I want to highlight for the audience, capital market assumptions and modern portfolio theory have been around since 1950 when it was discovered. It was really adopted in 1970s. Harry Markowitz, who lives next door to a retired teacher in California, received a Nobel Prize for it. It is the core of the investment theory behind our portfolio. There are lots of critics. We openly acknowledge it's not perfect, but we also acknowledge the fact that none of the critics have ever been able to develop a better solution and a better system. So from a fiduciary standpoint, this is the investment theory we recommend you rely on to build this portfolio. So we openly acknowledge it's a flawed tool, but we also state very clearly it's the best fiduciary tool at this point. The bottom line, I can't emphasize enough, we're trying to estimate the future. And unless any of you have got a newspaper from 2020 that you can give us, a Wall Street Journal, we're going to have to make estimations about the future, and that's not easy practice. So we're going to talk about risk. The little symbol up there is the Chinese symbol for risk, at least I'm told. I can't read Chinese. But the two symbols, risk is one, a danger, and second, it's an opportunity. So what I wanted to point that out is that while we'll use the term standard deviation as the measure of risk, think of that as volatility. You remember the distribution charts we looked at last couple meetings? Risk is not a single measure. Your life cannot be defined by a single measure of standard deviation. So we will also talk about drawdown risk. We'll also talk about our risk factors. But for today's exercise, we're really just going to zero in on standard deviation as that volatility measure. In June, when we come back, we'll also look at these other risk factors as ways to look at the portfolio. And then the other point, which I have to be reminded, is risk is not static. While we'll say 18% is today's standard deviation number, we know that it's a moving thing. It's not simple. So 2013, The Brave New World. This is going to be authored by you and not by Huxley. But it starts off with the point that rates are at all-time lows. The world is more globally interconnected than it has ever been. And then I want to recognize, I know we're going to have critics who are going to write editorials. I'm sure one of them will be a former board member who sat in your seat not long ago, who has been a very vocal critic of us. We've even had national publications who have criticized S&Ps. But there's a flaw in the math they use. They take these capital market assumptions and they just multiply them out forever to infinity. The capital market assumptions, a big component, for instance, of the equity return is the cash flow you get from dividends. So it's not that we're saying the world is going to compound and grow at 8% forever. 2 to 3% of that's going to come in the form of income. But we are predicting that the world will grow. It has in the past 80 years, not consistently, but it has. So to add and make it more robust to help with our critics, staff retained Gray and Company, so I'm pleased to introduce John Robinson, and I'll turn it over to him in a second. They're based in Atlanta, and what they did for us is a survey of all the institutional consultants so that you knew what other fiduciaries were looking at, so you had a better framework. Here's what we're picking, and then where are our peers? So from Ian's standpoint, you're right with looking at things from the big picture perspective. So with that, I'll turn it over to John, and if you want to bring up Gray and Company slides. John, I'll bring it to you.
Good morning. My name is John Robinson. I have my colleague Peter Lupoff. We're from Gray and Company. First, I want to start off and say it's a pleasure for us to be here today to present our results and some of our commentary on the capital market assumptions out there. To give you a little bit of backdrop of what we wanted to do, we wanted to go out to the largest consulting and also financial institution firms out there to get their idea of what they would think certain asset classes would be over a 10-year horizon. Needless to say, we went out to about, I would say, 16 firms. Not all those firms responded. Not all the surveys came back complete, but we feel very confident the information that we received back as far as expectations and also standard deviation, which Chris talked about, will give us a good baseline for you to look at when you go to develop your capital market assumptions that are out there. As I said, it's forecasting. It's not a perfect type of I would say art that's out there, but it's something to base what you're going to do in the future that's out there.
Can I just interject really quickly and just mention, are you comfortable with the board asking questions as you go along, or would you rather have us ask questions at the end?
It's fine. We can create a dialogue from that standpoint, and I think that's where it should be.
As board members have questions, feel free to chime in and we can.
Okay.
Thank you.
I'm going to hand it over to Peter. Peter will kind of go into the quantitative side of things and also our commentary on what we received back from all the respondents from the survey itself.
Thank you. Well, as John mentioned, this is a survey from participants, market participants, and another way to think about it is we can have it appear to be a science, but it's more art than science. It's a function of the inputs. It's a function of our experiences, and I think as we go through this, we'll discuss our findings, we'll discuss our perspective on that. In some instances, we at Gray & Company have a slightly different or nuanced point of view, and a lot of that nuance has to do with having active practitioners on the ground. With getting to 50,000 feet is one thing. I think starting at the ground, a plane can only get to 50,000 feet if it takes off, and having sort of a granular knowledge of markets and a granular knowledge of on-the-ground risks and how qualitative things shape these quantitative numbers is an important thing for you to consider. So I will discuss the findings, and then I will go through our interpretation and our perspective on that. And at any point along the way, if anyone has a question or comment, please chime in.
Our board is fairly, we love to interact and ask questions, so as concise and brief as you can be and just kind of get us to the point, that would be great. That way we have
Terrific.
plenty of time for interaction. That'd be wonderful.
That's a good
Surely.
review.
Our respondents, again, we are reporting back on a survey. So our respondents to the survey collectively find U.S. inflation expectations to be about 2.7% over the next 10 years. Now, this is down from the 3.1% average back in 2009. Our take on that, in part, is a function of the discussion we heard earlier about massive central bank easing. As we've heard, Japan just came in as the third largest economy in the world in participation with all central banks worldwide. And we, as mentioned too, we don't fight the Fed. I think a lot of the inflation fears that we'll hear about in markets from doomsday scenarists have us more cautious on the back end than on the front end. Those that see greater amounts of inflation have a tendency to see it because of supply-demand disequilibrium in energy markets in particular. We would, not to be the eternal optimist, but one of the things that we think could occur is that natural gas could give U.S. manufacturers some advantages, and the natural gas worldwide may dampen those expectations of inflation that runs away due to energy costs. Let's talk a little bit about fixed income and treasuries. The average cash return expectation is 1.7% over the next 10 years, and this portends continuation of negative real returns on cash over the near term, in our view, with an expectation of respondents of the long Treasury rates at an average of 2.9%, and U.S. investment grade projected at about 3.1%. You know, interestingly, high yield at 5.5% is still way lower than any of the estimates for any respondents in 2009 versus the present, way lower on all. Some comments, visceral reaction we have at Gray to this. When you get in the reads, as I mentioned, in the fixed income markets, senior secured loans are presently, this is today, cheap relative to bonds. You're secured in collateral, and loans have floating rate, which for those clients of ours and for those that have concern for interest rate risk, floating rate is an interesting way. Floating rate instruments and fixed income is an interesting way of dealing with that. Surely.
I ask this question all the time now. Are these returns arithmetic or geometric?
Do you know that?
Yeah, those are, based for what we see out there and looking at standard from a standard standpoint, we believe that there are more arithmetic returns versus the compounded way of doing it. Okay. And going back and
incorporating, these are arithmetic without incorporating the effect of the volatility that is also
yes, we wanted
would
to
be built in by the standard deviation.
We wanted to come and give you a basic, when we asked respondents out there, give us what your average would be out there from that, and so that's where we deem it would be from an arithmetic standpoint.
Just wanted to make sure I know what we're
The
looking
one thing
at.
I'd add, Paul, because I know we've had this discussion, is we've looked into them. It's not clear to us. I neglected when I worked with Gray to create the survey to ask that as a check the box type of thing, and so we're not sure if we have mixed results of compound and geometric and arithmetic. We think they're arithmetic. The real quick thing I would explain to the board, capital market assumptions used to be very proprietary, and the consultants would absolutely hang on to them and only provide them to clients. We used to pay a fee to get other people's. So people are more forthcoming, but we still didn't necessarily get to look under the hood on everybody. So.
Mr. Rosensteel's question is an excellent and very important question when looking at peer results compared to the recommendation that you might move forward on. So we studied these numbers pretty hard. And if you just asked the general question that Chris just highlighted, probably could have been asked a little bit more clearer, consultants will just throw you data. And we're doing these surveys at CalPERS and at State of Washington at the same time that we're doing yours. And these numbers appear to us to be compounded numbers, not arithmetic numbers.
Right, moving along just to, John, did you have a comment?
No, I can say, and I think Chris spoke to it, is how we went out with the survey to get an answer back for them. And Chris stated very well that it's very hard to get the methodology from all these consulting firms because it is under the hood. So based upon what information that we came back with, and also looking at how that we may perceive the market is and how consultants put out information, that's why we came to the conclusion. And most likely may be arithmetic returns, which may be a little bit different. That's it.
Dan, did you want to chime in on that? Or?
I'm just noticing that some of the numbers from the materials we have in our board book to the slide that you're showing, there are different numbers. And I was just curious as to why. I mean, they're not big differences, but they're different.
There could be slightly rounding numbers of what you have there. And also we got some information that came back. We gave them a certain cutoff date that we had there. And and a couple of the respondents came back after those cutoff dates. So they could be slightly different. And that's one reason we wanted Peter to put the numbers out there, but also give you our idea of the marketplace too.
Thank you.
Mm-hmm.
Two last comments on fixed income from our point of view is that we feel that the estimates in high yield may be a bit on the lower side, despite the fact that spreads in fixed income, whether it's investment grade or high yield, are at historical lows. The massive amount of central bank easing creates a very low likely default cycle. Companies are pushing out maturities. They have access to capital markets. There's nothing I guess never say never, but there's little in this environment that suggests the kind of leverage in systems that we saw in '08 that could create the kind of tidal wave of defaults that could occur. The only additional comment on this with regard to fixed income is that that also suggests that there's little likelihood of material gains in the distressed environment near term with a low default cycle. In equities, the respondents came back with anticipated returns of 8% over the next 10 years. This is a global number, with U.S. and other developed markets slightly under at 7.9%, emerging markets in just under 10%, and there was divergence of opinion. Now, I point this out because in most of the numbers that we analyzed, there was not a great amount of divergence of opinion. 5 of our respondents were lower, others were higher than in 2009. At Gray & Company, our take on this is that we believe that the equity markets actually globally have the prospect of more heightened returns than the respondents are showing for a couple of reasons. There's the talk of the theoretical great unwind with people moving out of fixed income and into equities. Part of that is stimulated because the S&P returns 2 and change in dividend yield, where the average fixed income instruments, investment grade and high grade and high yield, are paying vastly lower than that, on average 2.6, I believe. So dividends from equities are, as pointed out, a very important part of equity returns, number one. Number two, there's a secular change in the investing community with an aging population. An aging population looking for income securities. So to the extent that the risk-free rate is managed worldwide at about 1%, as we've witnessed, the great unwind isn't so much out of fixed income and into equities, it's out of money market. And this is sort of more granular today, out of money market and into the equity markets. And that's something that we see sustaining, and we believe that there could be greater gains out of the world equity markets relative to U.S. and greater than the consensus found among our respondents. One last comment on that is that it feels that in the U.S., with cash on the balance sheet of companies and with an aging population and with the internal rates of return that companies have to use their cash to do other things to grow their business, that between activists and what feels like a newly forming social contract, this may be a bit of our own optimism, but we think we are seeing a growing social contract between corporate America and investors to return capital. And I think companies will be rewarded that are shareholder friendly. Shareholder friendly doesn't necessarily mean to return capital through higher dividends and through share buybacks, but it's a good start in the absence of anything better to do with cash on the balance sheet. And I think we see that as a coming trend with a secular change in the age of the investing population. In alternatives broadly, the respondents found was likely to return roughly 5.6%. That has to be a broad amalgam of strategies, and I think here's where tactically your consultants and direct investors need to be thinking and parsing through the returns, because the return characteristics are wholly variable. The idea that there's a 5.6% return that would come from an alternative manager broadly masks the fact that there will be some strategies that will significantly outperform, some that will significantly underperform. Among those strategies, interestingly, the respondents found that private equity is anticipated to deliver roughly 10%. What is interesting to us about that, from our own perspective, is that the question then comes, there's something odd in the mismatch between the liquidity in a private equity investment and the liquidity in liquid cash equities. If the equity markets worldwide are going to generate 8%, or we believe better than that, and you'll get 10% from your private equity investments, but be subject to a long-term lockup. The question is, are you getting properly compensated for the lack of liquidity in your longer-term investment? Or are the private equity investment returns likely to be significantly larger? Private equity returns will be a function of multiples paid for companies, and of the multiples we see in the public equity markets, which 8, 9, 10% returns worldwide, would suggest they could appreciate considerably, and private equity probably returns more than 10%. But in any event, there's something odd about the narrowness between the returns in a longer-term locked-up product and a daily liquid equities product. In private equity, we believe in the near term that there will be significant activity. That's a function, again, of the global low risk-free rate, equal and easy access to capital markets, and what appears to be about $1 trillion in private equity money that sunsets this calendar year. So the stars feel aligned for, in the near term, private equity to spend a lot of money buying companies, probably spend, and that's not to say that that will be unattractive, but what we've seen in the first quarter of 2013 is the single fastest increase, single largest amount of allocation to private equity deals, the single largest number of deals announced since the first quarter of 2007. The multiples that are being paid, just anecdotally, are materially higher than many would anticipate. People no less known than Warren Buffett have paid material multiples for companies like Heinz, which seemed unexpected, except that the rate of return that we're looking for is a function of this low return environment that we're in presently. I think the risks that, volatility estimates were mixed. Two of our respondents were flat to 2009 over the broad asset classes. The majority saw rising risks, particularly in global equity. And I think that here's an instance, it's not inappropriate to think of these as sideways trading markets. We're going through a massive worldwide deleveraging. And I think that many of the respondents qualitatively are helping to make what feel like quantitative decisions, but with having lived through 08. And having lived through 08, I think there's this heightened sense of awareness of risks out there, and as Donald Rumsfeld called them, they're the unknown unknowns. So they're the known knowns that we all worry about. There's Europe. There's the fact that there is not a government in Italy. There's Iran, Korea. There's the apparent dysfunction in the U.S. But what's very interesting is that when you look back at what was called the flash crash of May 10, 2010, if you look at the European crises, the peak of their headlines in 2011, and you look at fiscal cliff, you look at the sequester, and if you look at market reaction to those events, those headline events, is that over that 2 or 3 year period of time, the movements in the S&P and global markets have been muted over time. They were heightened in 2010, and they've muted over time because finally central bank easing has gotten to a place where investors want to put money in the markets, and we are beginning to see that the U.S. markets are somewhat disconnected from global markets, that the fear of contagion, which is an easy fear to stoke if you're a doomsday scenarist, contagion due to what's happening, what has happened in Europe, may not necessarily hurt U.S. markets, which still seem to be the safe haven for capital worldwide. The unknown unknowns, if I knew them, I would tell you. We'll talk a moment about the economic backdrop as we see it. I'm sorry, if there are any questions that we should. We believe we're seeing a modest economic thaw. You're seeing, while job numbers are up and down month to month, that the trend is right. Manufacturing the trend seems to be right. Consumption is, and so is housing. Our concern with the consumption numbers is that they mask the fact that the improved economy still leaves out a disenfranchised, lower economic consumer. That it's disproportionate, that we are back to 2007 levels for many consumers in the U.S., but for a disenfranchised class in America. And it's not a political statement, just seems to be a case, and so that tempers our view for what businesses will make money and what won't, and perhaps what needs to be done. The central bank easing, does it postpone the inevitable? Well, if you look at some of the work of academics like Reinhardt and Rogoff, who would say that when a global economy's debt to GDP exceeds 90%, they can't come back from it, misses the point that there's a very big difference between the Italian economy and the Slovenian economy, and that not all economies can be dropped into a simple formula. As mentioned, I think that we are in sideways trading markets, and where investors, given the low risk-free rate, are somewhat indifferent to global dysfunction, and that feels like that is going to persist for some time. Are there any questions that we should address?
Yeah, Peter, can you get into the assumptions on 2013? The survey forecast?
All right. I can't actually see that. So I'm going to refer to my book.
So page 9 on the book, IND 123.
Okay, if you wouldn't mind.
Sure. If we look at the assumptions and we took the main, what we say, asset classes, cash, fixed income, global equity, absolute return, private equity, commodities, and inflation. Peter kind of talked about what the inflation number was, around 2.7. If we look at cash, on average, it was about 1.65. We looked at the maximum min. The minimum was about 0.25%, and the maximum was 3.60. If you also look at fixed income, it ranged from a low part of 1.25 to a high of 420. Global equity ranged from 7.25 to 9.80. If we look at hedge fund or absolute return, 3.13 to 7%. Private equity, 8% to 12.3% is a range. Commodities, 2.5.
I'm sorry, Rob, instead of we have the term for them, can you just tell us what it means for us in terms of interpretation?
Yeah, if you kind of look at, if you look at the graph and look at when we look at these numbers, we look at dispersion that's in there, the high and the low, and what the average would be. So there's a very tight range between cash, fixed income, and global equity. So from those respondents, and we know that there's some leeway in there from between the lowest and the highest, but we can justify that range that's there because it's a low dispersion. As you start moving out to absolute return and also, which is a wider dispersion, and so that's where you have some concerns on what's happening in that market. The wider is, the more the differences that you have out there when people coming back and giving you a number. The same thing as you move towards private equity. You have a big range. You have over, if you look at a low of 8% to 12, to 12%, a 400 basis point range in there. So and that could be depending upon what they're looking at and how their assumption is from what's happening on the U.S. Is that global or is it just U.S. as a buyout, depending on the strategy you're looking at too. And also from a commodity standpoint, if you looked at inflation, very, very narrow range. So you said, okay, I can, that's something that we can really understand from that standpoint. So when we look at these numbers and look at the averages and look at the maximum and min and coming back and looking at the dispersion standpoints, so the areas that you would have some concern with these respondents coming back to would be the private equity and also the hedge fund portion of it. There may be some questions about the global equity side, and maybe people have been a little bit conservative from that standpoint. Peter stated that it's a little bit conservative, but that may be something that's going to have some significant growth over the next 10 years. So if you look at, those are the main takeaways to take away from that assumption chart. Okay. If we move forward, we also wanted to get an idea of some of the concerns that the consultants had regarding their plans that are out there. Funding status was the number one concern, and also low interest rates, which I think, that was an obvious from that standpoint, and also governance too, especially what's happening overseas and everything else, and some of the what's going on over there. So, and that's where, and also if you look, this chart too, it did not include, I would say, not less than half the respondents really responded to this chart. They gave us more of the numbers, but didn't really want to give up that information. That just goes back to them trying to keep some of their methodology of what they think is going to happen in the future themselves. Then if you look at the next chart, we want to say what's going to contribute, what are the attributes of your investment success, and as we know, asset allocation is key. Where you're going to put your money in, and also selecting the best managers from that standpoint. So you went from asset allocation to portfolio diversification, then risk control. So that was not surprising at all that it was in that order when we get the survey back from everybody else. So I think these last two slides pretty much in line for what you're looking at. And then if we go back and talk about the assumptions that are out there, you do have some dispersion in there in some of those key asset areas, but it seems like everybody pretty much is in line with what we're looking at. Mm-hmm.
So these 4 slides previously, which showed the 2009 and the 2013 expected returns and standard deviation. So it's fair to conclude pretty much that in pretty much all asset classes, the return expectations compared to 2009 have gone down. Gone down.
Have gone down, not in all asset classes, but I think if you look at it, I think when you look at 2009, you were coming out of 2008. So people were very nervous coming out and giving you a very conservative standpoint. So if we go back and forth, we know that cash is a little bit lower just because we have all those quantitative easing and everything that's in the marketplace.
I guess, if we built a portfolio based on, and this is a separate question from what our capital market assumptions were in 2009, but in general, is the investment community today building investment portfolios based on expected lower returns without lower volatility than they were 3 or 4 years ago? Because that's what it seems that your survey is suggesting. So if we're going to be kind of, doing what others are doing, would we be building a portfolio based on less optimistic capital market assumptions than we would have been 3 or 4 years ago? Because that's what it seems these numbers are saying.
They're less optimistic in the absolute sense, but relative to the risk-free rate is probably the way to think about it. And I know that you have your own particular needs that you need to drop this into a framework and say, can we get to where we need to get to? That's a problem everyone has that's trying to meet certain hurdles or needs, that central bank easing is flooding money into markets and increasing asset prices, and that can persist. But what is the proper rate of return over a risk-free rate?
That's not what I'm asking, because ultimately we're going to pick a portfolio with an expected return, not an expected risk-free rate, an expected real-world rate. And so what this seems to me to be saying, for whatever reason we're getting there, change in the risk-free rate that the market believes in, but that the world is today building portfolios on less optimistic capital market assumptions than it was 3 or 4 years ago.
That's accurate.
Okay, thank you.
That's accurate.
Thank you.
No, and I think from what we talked about, these are forecast. And like we said, it's not science, it's an art. And from what we had out there and the people and the firms the bigger firms that we solicited out there, we think we can give you a good baseline to go from. And work with your consultant and staff to come up with where you need to be as far as your assumption and also asset allocation. So it's an imperfect science that are out there, and also the view of what's going on domestically and international has a lot to do with that right now. And some of the risk and uncertainty, you have to take that into consideration too. Okay.
Thanks, Sean. Thanks, Pete.
Thank
Anything
you for your
else?
time.
Yeah, thank you.
You
Thanks so
guys
much.
can stay up there.
Do you want to stay up?
Debate, but if
Are
you
we
want to
moving
pass
to
the
this?
control over to Neil and Alan, and we'll kick it over to you guys.
All right.
So I would ask Neil and Alan to go through their particular assumptions. Their paper starts on INV 133. Their exact assumptions are on INV 161. Yeah, John, if you could bring those up. And just, oh, you got it. That's right. So from the staff perspective, we are supporting PCA's recommended capital market assumptions.
These are our assumptions. We've constructed these independently of a peer review. The basic themes are similar and trends are similar to what the peer review indicated. Our returns, going to Mr. Rosenthal's question about are these returns, if you built a portfolio based off these returns versus what we did in 2009, the answer is yes, the expected long-term return would be lower. You can see the same theme in terms of lower fixed income and lower risk-free rate assumptions baked in here. We're very, over the next 10 years and maybe a little bit longer, for the sake of a better term, we're quite bearish on what fixed income instruments are going to provide to you. That's no news to you. We've been talking about that for a while. And on the equity side, these are arithmetic returns you see here. When you compound these out and ask yourself what you're going to get over 10 years, what comes out of that is equity risk premiums that are probably about 100 basis points lower than they were back several years ago. So we have tweaked those down as well. And I'm happy to answer any questions.
Sorry, I need to modify. I stated that staff recommends these as printed. The one I would like to see a debate about, in addition to equity if you want, but is real estate. Because I think what we heard earlier, so not everybody heard it, but we've had a bit of a chicken and the egg discussion. PCA's real estate assumption is based on our real estate portfolio as it exists. But as Michaelin has said, we're shooting for a different real estate portfolio in the future. She's basing your benchmark return on what PCA is expecting. So I need one of them to go first. And I'm going to, when you're ready, I had warned Michaelin, I'm going to pick on her so we get her perspective on what she thinks you've said you want out of the real estate portfolio. What's a good forward-looking goal for the real estate portfolio, rather than what we have just today?
Preliminary comment, you see that these are, in a sense, generic classes that we have up here. They are not necessarily STRS' classes. So there are certain instances where we customize our assumptions based on what STRS is doing or based on what STRS is expected to do by particular asset class portfolio. So you can see here that we've got core real estate penciled out at a 640 expected return. That's an arithmetic return. That means what you'd expect to occur in any 1 year. You're going to get a 640 with a lot of error around that. But core real estate means no leverage and means very high quality properties, has nothing to say about opportunistic or value add or how much leverage applying. So I dialogue with Mike DeRay every time we do this. Sometimes Michaelin is in on the conversations as well. But you can expect that you have a very different long-term assumption for your real estate portfolio than for what our generic assumptions show. And the differences are quite dramatic. I think in dialoguing with Mike, we have an expected arithmetic return of over 8% for your real estate portfolio based on where it's going to go in the next 5 years or so. So I'll stop there and happy to answer any questions. I'll empty my seat to Michaelin if she wants to. Okay. But we will use these as a baseline, these assumptions. The recommendation that Chris is teeing up is we will use these assumptions as a baseline off which we build your expectations for your asset classes.
Okay, great. Thanks.
I just,
Oh, I'm sorry, I got
Madam Chair, can I just,
Sure, absolutely.
it's just, as you look at these numbers, what's really important to keep in mind is that third column where we show the risk. The greater that number is, the larger the diminution in return in the column to the left. And that's the penalty for volatility. So the expected return of private equity is 12 in any 1 year. What does it come out to?
About 10.
So you lose 2% for volatility in what you would really get. Compounded. So 2% a year. So you would take for a 10-year period, that's 1.02 to the 10th power. It turns out being a really big number. And so it's, when we look at the total portfolio, that's somewhat mitigated because of diversification. But there's volatility in whatever portfolio you put together. And in fact, you won't get those kind of returns. You're going to get something significantly less than that, and than a simple average of those numbers. And that's what's important to keep in mind.
And one other comment, just based on what Alan just said, if you take a look at the 4.5 number under bonds, then look at the 18 number for domestic stocks, what we're saying is that equities are 4 times more risky than bonds. And if you take a look at the 26 compared to the 18, we're for private equity versus public equity, we're saying that public equity in general, based on our assumptions, is 50% more risky than investing, or 50% more risky investing in private equity than when you invest in public equity. So that's the basic, those are the themes that come out of our asset classes.
Yes. Just to clarify a few things, the hedged international stocks is just referring to currency hedging? Yes. And the basic real return is real assets? Or what?
It is a combination of tips, commodities, and a couple of other real assets. And it's just a very generic combination. It does, but it's also in the basic real return class here. Yeah, I think infrastructure's in there. So you got tips, commodities, infrastructure. But it's just a very basic view on a real return. It's not what you have in place. You're going to have a different looking real return class when we model it.
And would you comment on or explain why all 5 fixed income categories are 2.25?
Well, the basic theme is you're just not getting rewarded for that. I mean, they didn't used to be like that, right? If you go back to 2009 or go back to 2006, you were getting some risk premium in the form of a term premium for treasuries or for some of the fixed income instruments, a little bit of credit premium. You're just not getting rewarded for that today. The yield on it, what we do when we look at bonds is we look at a broadly diversified benchmark, first of all, and see what the yield to maturity on that is. And it's going to be roughly analogous to what you own in your portfolio. The market that we typically use for domestic core, for example, is what's called the Barclays Capital Universal Index, which by definition is every single U.S. dollar denominated bond on the planet. That includes treasuries, mortgages, credits, et cetera. Well, the yield on that is about 2.15% as of the end of the year. Then you got to ask yourself, is the Fed going to be friendly to you or be against you going forward the next 10 or 20 years? And the answer is they're not going to be your friend. So the best you're going to get is somewhere around the yield. The yield is low. I mean, it's just low. And so that's where we get these from. And they're basically all in the same group, whether it's international bonds, core bonds, or inflation-protected bonds. They're all facing the same headwind. And all their yields are low. So it's quite the challenge for bonds these days.
But the only one that's really an important difference is cash. And that is, this is showing a return for cash of 2.25, when, as we all know who have any cash savings account, we currently get 1 basis point. And so that's an expectation that the return on cash is going to increase, which is consistent with our belief that there's going to be higher inflation in the future. That higher inflation will disadvantage all of the sectors of the bond portfolio. And so I would argue that that 2.25 for all of those other classes of bonds sadly may well be an optimistic assumption of the future return of the asset class as opposed to the most likely.
And just to follow on, I mean, there is an assumption in a 225 like that, and even in a 1.7 for the peer survey, based on what Alan said, of what you think the Fed's going to do. So in the back half, we don't expect the Fed to have a short-term lending rate of 25 basis points 10 years from now. We think it's probably going to end up being somewhere between 3 and 4. I mean, that's what's in our assumptions.
And, well, I guess sort of two more questions. This is your 10-year expectation? And this is the reference to the 3% long-term inflation assumption. That is net, these are net of inflation or plus inflation?
No.
No.
So you're going to get a negative 75 on cash.
You're going to lose purchasing power by holding fixed income instruments for a decade.
I thought that was it. I just wanted to make sure
Yeah.
that was
They're not real returns.
clarified.
Yeah.
Thank you.
And just to follow the previous discussion, that's why money's flowing into equities, because anyone who looks at their personal savings account says it's losing purchasing power. Right now, I can get a higher dividend by holding Microsoft and GE than I can in the bond market. I'm putting the money over there. And that's happening on a global basis as there's been a repression on yields. And your real estate consultants.
I was going to say, Michael, do you want to?
I'm just thinking about how I should rebalance my account. No, I'm kidding. I don't think we're as far apart as we were initially. I just spoke with Mike, and as Neil indicated, they were just above an 8 when we initially started this conversation. And if you look in your strategic plan, your real estate objective is a 9.25. That was a number we do not believe that your conservative position that you've instructed us to move to was going to be able to fulfill on a going forward basis. And there's two reasons for that. First of all, the economic growth is just really not there for real estate to have another bubble like we had before, projections for that, and those are demonstrated in your projections you see here in the other asset classes. And also you have a significant amount of capital already invested and very little to put into the market today. And most of that capital was invested at the peak of the market and is only going to do so much on a go-forward basis. So rebalancing it. My understanding from Mike is that you are at an 8.5. When I take the portfolio composition the board elected, which is the 50, 20, 30, use our expected returns for each of those styles, and we're not that far off. We say 7% net for core, but we include some leverage there. 8% for value and 10% for opportunistic actually comes up to 8.1, so we're 40 basis points off. So I think we're actually fine.
That's what it'll be.
Fine.
Yep.
No, I'm sorry, on this. Do you have more? Is there any more that you're?
Madam Chair, before you is the decision on
To adopt the
what we're
capital
going to
market
use to do the modeling, and we need your direction on where to go.
Yeah, I do have some questions on the, I really appreciate this. This is very, very interesting, helpful reading. And feel like there's questions to be asked, but not sure there's a basis for questioning the conclusions. But I guess the one that I don't quite understand is the equity returns, and it's partly because of what you just mentioned, Alan, that you know, it's better because the real risk-free rate of return is negative, that equities companies are going to borrow and invest, and that's going to drive up the value of equities, and so it appears that your a couple of statements that sort of suggest that the expected annual risk premium return over the risk-free short-term assets is something that should be increasing, that the return to equities relative to the risk-free real rate of return should be going up. And so you're saying that it's 6.5%. What was it in our last go around of doing capital market assumptions? Do you know?
I can't. I wish I had that table I produced for you last week, but
I guess I have.
but it's been, I think, to be honest with you, I think it's about the same over the risk-free rate that it has been in the past.
It's a little lower from 2009 to today. It would be a little bit, that has